You know what's fascinating about algorithms? They don't panic. They don't get emotional. They don't watch CNBC and change their mind based on what some talking head says. They just process data, identify patterns, and execute. And right now, across multiple institutional trading desks, something remarkable is happening. The algorithms are flipping to buy, not cautiously, not tentatively, aggressively. Let me show you what I'm seeing, because this isn't speculation. This is happening in real time, and the implications are massive. 3 days ago, I was reviewing positioning data from the COMEX, and something caught my eye. The commercial traders, the big banks that typically short gold and silver to hedge their physical operations, they started covering. Not slowly, rapidly. In a single week, they reduced their net short position by 47,000 contracts. That's 4.7 million ounces of gold. To put that in perspective, that's more than most central banks hold in their entire reserves. But here's where it gets interesting. At the exact same time, the managed money accounts, the hedge funds running systematic strategies, they flipped from net short to net long. The algorithmic models that drive billions in capital, they all triggered buy signals within a 72-hour window. That's not coincidence. That's pattern recognition at scale. Now, I want you to understand what's actually happening here, because the mainstream financial media is completely missing this story. They're talking about interest rates and inflation data and Fed policy, and sure, those things matter. But what's driving these algorithmic buy signals goes much deeper than the next CPI print. The algorithms are reading something in the market structure itself. They're seeing divergences that human traders miss. They're processing thousands of data points simultaneously, correlations between currency movements, bond yields, commodity flows, central bank reserves, ETF holdings, mining production, industrial demand, and geopolitical risk premiums. And when you feed all of that into sophisticated machine learning models, they're all arriving at the same conclusion: accumulate precious metals. Now, let me walk you through what these systems are detecting, because once you see it, you can't unsee it. First, there's the dollar correlation breakdown. For decades, gold and the dollar moved inversely. Dollar up, gold down. Simple relationship. But starting in October, that correlation broke. The dollar strengthened and gold went up. That's not supposed to happen. The algorithms noticed immediately. They started testing. Is this a temporary anomaly or a structural shift? 3 weeks of data confirmed it. Structural shift. That's a massive buy signal, because it means gold is decoupling from its traditional drivers. It's moving on its own fundamental demand, regardless of dollar strength. Second, the algorithms are tracking physical flows, not paper contracts, actual metal. And what they're seeing is unprecedented. In November alone, 95 tons of gold moved from COMEX warehouses to private vaults. That's physical metal leaving the exchange system. At the same time, Shanghai Gold Exchange withdrawals hit a 5-year high. That's metal moving from west to east, from paper markets to physical possession. The algorithms interpret this as supply tightness. When physical metal starts disappearing from exchanges, prices historically spike within 90 to 180 days. Third, there's the central bank buying pattern. Now, we all know central banks have been accumulating gold. That's not news. But what the algorithms detected is the acceleration. In 2023, central banks bought 1,037 tons. In 2024, they're on pace for 1,200 tons. But here's the key. The buying is concentrating. It's not spread evenly throughout the year. It's clustering in specific months: September, October, November. Heavy accumulation, then a pause, then another wave. That's not random. That's coordinated. The algorithms recognize coordination patterns, and when they see multiple central banks buying in synchronized waves, that's a signal that something bigger is coming. Fourth, the mining production data. This is subtle, but it's critical. Global gold production peaked in 2018 at 3,300 tons. Since then, it's been declining, not dramatically, but steadily. We're now at about 3,100 tons annually. Meanwhile, demand has been rising. Industrial demand, jewelry demand, investment demand, central bank demand. The algorithms are calculating the supply-demand gap, and it's widening. By their models, we're heading into a structural deficit by mid-2026. That's not a maybe. That's a mathematical certainty based on current production curves and demand trends. Fifth, there's the geopolitical risk premium. The algorithms don't watch the news like we do, but they process event data. They're tracking sanctions, trade restrictions, military conflicts, currency swap agreements, and de-dollarization initiatives. And what they're seeing is a systematic unwinding of the post-1971 monetary order. Countries are diversifying away from dollar reserves, not because they hate America, but because the game theory has changed. If you're Russia or China or Saudi Arabia or Brazil, holding all your reserves in dollars means you're vulnerable to sanctions, to inflation, to policy decisions made in Washington that don't serve your interests. So you diversify. And the primary diversification asset is gold. The algorithms are quantifying this trend, and their models show it's accelerating, not slowing. Now, here's where this gets really interesting for individual investors like you and me. Because when institutional algorithms flip to buy, they don't just buy a little. They buy systematically, consistently across time. They're not trying to time the perfect entry. They're accumulating positions based on probability-weighted outcomes. And right now, their models are saying the probability of significantly higher gold and silver prices over the next 12 to 24 months is above 70%. That's a high conviction signal. But there's a problem. And this is what most people don't understand about algorithmic trading in commodity markets. These systems are designed to accumulate positions without moving the market too much. They use sophisticated execution algorithms that break large orders into thousands of small trades, spread across time and across exchanges. They're trying to build positions quietly, but eventually, the market notices. Other algorithms detect the buying pressure. They start front-running, and that's when prices start to move violently. We saw this exact pattern in 2019. In June and July of that year, gold was trading around $1,400. Quiet, boring, nobody was talking about it. But if you looked at the positioning data, the algorithms were accumulating, steadily, relentlessly. Then in August, something triggered. Maybe it was the Fed's rate cut. Maybe it was the repo crisis. Maybe it was just the weight of all that accumulated buying. But gold went from $1,400 to $1,550 in 3 weeks. A 10% move in less than a month. And it didn't stop there. By August 2020, gold hit $2,070. That's a 48% gain from where the algorithm started buying. Now, I'm not saying we're going to see a 48% gain in the next year. I don't have a crystal ball. But I am saying the setup looks remarkably similar. The algorithmic positioning, the physical flows, the central bank buying, the supply-demand dynamics. It's all lining up. And here's the thing about algorithms. They don't care about your opinion. They don't care if you think gold is overvalued or undervalued. They don't care if you believe in gold as money or think it's a barbarous relic. They just process data and execute. And right now, they're executing buy orders. So what does this mean for you? Well, if you're sitting on significant retirement savings, if you got $100,000 or more in traditional accounts, this is probably worth paying attention to. Because when institutional money starts moving into an asset class, retail investors typically follow 6 to 12 months later. By then, prices have already moved. The opportunity is now, while the algorithms are still in accumulation mode before the broader market catches on. Quick aside here, because I know some of you are thinking about how to actually position for this. I put together a free guide on gold IRAs, how they work, how you can get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. Covers the mechanics, the custodians, the storage, the whole process. If you're in that situation where you've got substantial retirement savings and you're thinking about diversification, it's worth a look. No obligation, just information. All right, back to what's happening in the markets, because there's another layer to this that's absolutely critical. The algorithms aren't just buying gold, they're buying silver too. And the silver signal is actually stronger than the gold signal. Let me explain why. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. About 50% of silver demand comes from industrial applications. Solar panels, electronics, electric vehicles, medical devices. And that industrial demand is growing rapidly. Solar panel installations are projected to double by 2027. Electric vehicle production is ramping up globally. Every EV uses about 25 to 50 grams of silver in its electrical systems. That's not a lot per vehicle, but when you're talking about millions of vehicles, it adds up fast. At the same time, silver mine production is constrained. Most silver comes as a byproduct of copper, lead, and zinc mining. Only about 30% comes from primary silver mines. So when copper prices are low, or when lead and zinc production slows, silver supply drops. And right now, we're seeing exactly that. Copper production is facing challenges in Chile and Peru due to declining ore grades and water shortages. That means less byproduct silver. The algorithms are calculating this supply-demand equation, and their models are showing something remarkable. By their estimates, we're heading into a silver deficit of about 200 million ounces annually by 2026. That's massive. To put it in perspective, total annual silver production is only about 830 million ounces. A 200 million ounce deficit means demand is exceeding supply by nearly 25%. That's not sustainable. Something has to give. Either demand has to fall, which seems unlikely given the industrial trends, or prices have to rise to incentivize more production and ration demand. The algorithms are betting on higher prices, and they're positioning accordingly. Now, here's where the institutional move gets really interesting, because it's not just hedge funds and trading algorithms, it's pension funds, it's sovereign wealth funds, it's family offices. These are the big, slow-moving pools of capital that typically don't chase trends. They move deliberately, based on long-term strategic allocation decisions. And they're starting to increase their precious metals exposure. I was talking to a consultant who works with pension funds last week, and he told me something fascinating. He said 3 of his clients, major public pension funds with billions in assets, have recently approved increasing their commodities allocation from 2% to 5%. And within that commodities bucket, they're specifically targeting precious metals. That's a huge shift. These are institutions that make decisions on 5 to 10-year time horizons. They're not trading, they're allocating. And when they allocate, they buy and hold. Think about what that means. If just 1% of global pension fund assets, which total about $50 trillion, moved into gold, that would be $500 billion of buying. The entire gold market, all the gold ever mined, is worth about $15 trillion at current prices. So $500 billion would be a 3% increase in total demand. That would move prices significantly. And it's not just pensions. Sovereign wealth funds are doing the same thing. Norway's government pension fund, the largest sovereign wealth fund in the world with over $1.5 trillion in assets, has been quietly increasing its gold exposure. They don't announce it. They don't make press releases. But if you dig through their quarterly reports, you can see it. Small increases, quarter after quarter. That's the algorithmic approach at the institutional level. Steady accumulation. Now, let's talk about what happens next, because this is where it gets really important for individual investors. When institutional algorithms flip to buy, they typically stay in buy mode for 12 to 18 months. They're not day trading. They're building strategic positions. And during that accumulation phase, prices tend to grind higher. Not in a straight line. There are pullbacks, consolidations, periods of sideways movement, but the overall trend is up. And then, at some point, usually when the algorithms have accumulated their target positions, something triggers. Maybe it's a geopolitical event, maybe it's a currency crisis, maybe it's just the weight of all that buying pressure. But prices start to accelerate. That's when you get the big moves, the 20%, 30%, 40% gains in a matter of months. We saw this in 2010 to 2011. Gold went from $1,200 to $1,100 in about 10 months. We saw it in 2019 to 2020. Gold went from $1,400 to $2,070 in 13 months. And in both cases, if you look at the positioning data, the algorithms started buying 6 to 9 months before the big move. They were accumulating while everyone else was skeptical. Right now, we're in that accumulation phase. The algorithms started buying in September and October. We're now in mid-December. That means we're about 3 months into what could be a 12 to 18-month cycle. If history is any guide, the big price moves typically come in the second half of that cycle. So we're talking about mid to late 2026 for potential acceleration. But here's the thing. You don't want to wait until prices are already moving to position yourself. Because by then, everyone sees it. The financial media is talking about it. Your neighbor is asking you about gold. And prices have already moved significantly. The opportunity is now, while it's still quiet, while the algorithms are still accumulating, while most investors are focused on stocks and bonds and crypto. Let me give you a specific example of how this plays out, because I think it'll make it more concrete. In early 2019, gold was trading around 1,180. The stock market was recovering from the December 2018 sell-off. Everyone was bullish on equities. Nobody was talking about gold. But if you looked at the COMEX data, the managed money accounts were starting to build long positions. Slowly at first. Then more aggressively. By June 2019, they had accumulated a net long position of about 250,000 contracts. That's 25 million ounces of gold. A massive position. At the time, gold was still around $1,400. It had moved up a bit, but nothing dramatic. Most investors didn't notice. But then in August, the Fed cut rates, and gold exploded. It went from $1,400 to $1,550 in 3 weeks. The algorithms that had been accumulating for months suddenly had huge profits, and they didn't sell. They held, because their models were saying this was just the beginning. And they were right. Gold continued higher, eventually reaching $2,070 in August 2020. The algorithms that started buying at 1,180 in early 2019 saw gains of over 60%. And the key is, they didn't try to time the perfect bottom. They just recognized the setup and started accumulating. That's the institutional approach. Now, fast forward to today. Gold is trading around $2,650. Silver is around $30. The algorithms are accumulating. The setup looks similar to 2019. The question is, are you going to wait until gold is at $3,000 or $3,500 to pay attention? Or are you going to recognize the pattern now, while there's still time to position? I'm not saying you should put all your money into gold and silver. That would be foolish. Diversification is always important. But if you have zero exposure to precious metals, if your entire portfolio is in stocks and bonds and real estate, you're missing a critical hedge, because the scenarios where gold and silver perform best are exactly the scenarios where traditional assets struggle. Currency devaluation, geopolitical instability, financial system stress, inflation. These are the environments where precious metals shine. And here's the thing. The algorithms don't care about those narratives. They're not buying gold because they believe in some apocalyptic scenario. They're buying because their models say the probability-weighted expected return is positive. It's pure mathematics. And right now, the math is compelling. Let me show you one more piece of evidence, because I think this will tie it all together. There's a metric called the gold-to-silver ratio. It measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 1, meaning 60 ounces of silver equals 1 ounce of gold. But the ratio is volatile. It can swing from 40 to 1 in bull markets to 100 to 1 in bear markets. Right now, the ratio is sitting at about 88 to 1. That's elevated. It means silver is cheap relative to gold. And the algorithms are noticing. They're buying silver more aggressively than gold, betting that the ratio will revert to its historical mean. If it does, and silver moves back to a 60 to 1 ratio while gold stays at current levels, silver would need to rise to about $44. That's a 47% gain from current prices. But here's where it gets really interesting. If gold rises to $3,000, which many analysts are projecting, and the ratio reverts to 60 to 1, silver would need to be at $50. That's a 67% gain. And if gold goes to $3,500 and the ratio tightens to 50 to 1, which has happened in previous bull markets, silver would be at $70. That's a 133% gain. Now, I'm not saying silver is going to $70. I'm just showing you the math. The algorithms are running these scenarios, assigning probabilities to each outcome, and calculating expected returns. And their conclusion is, buy silver, aggressively. The institutional move is happening. The algorithms have flipped to buy. The question is, What are you going to do about it? Because here's the reality. Most people will do nothing. They'll read this, think it's interesting, and then go back to their daily lives. They'll wait until gold is at $3,500 and silver is at $50. And then they'll wish they had acted when they had the chance. That's human nature. We're wired to follow the crowd, to wait for confirmation, to avoid risk. But the institutions don't think that way. They act on data. They position ahead of the crowd. And they profit when everyone else finally catches on. You have a choice. You can wait and see what happens. Or you can recognize the pattern, understand what the algorithms are telling us, and position accordingly. Not with money you can't afford to lose. Not with your emergency fund. But with a portion of your portfolio that's allocated to alternative assets, to hedges, to diversification. The setup is there. The data is clear. The algorithms are buying. The institutions are positioning. The central banks are accumulating. The supply-demand fundamentals are tightening. The geopolitical risks are rising. The monetary system is shifting. This isn't about fear. It's not about predicting the end of the world. It's about recognizing a major shift in capital flows and positioning yourself to benefit from it. The algorithms don't have emotions. They just process data and execute. And right now, they're executing buy orders in precious metals. The institutional move is happening right now. The question is, are you going to participate, or are you going to watch from the sidelines?